Welcome to Every Dollar Counts with Josh and Jay, a shot of truth serum for your investment and insurance questions. I'm Josh Null, the owner of Gulf Coast Financial Advisors. I'm joined by my co-host, Mr. Jay Stubbs, director of the Gulf Coast for First Protective. We are brought to you on the Prime Capital Investment Advisors podcast network. So, Jay, we have a very special guest today. It's actually our first returning guest. So, listeners, would you please welcome back Mr. Will Steih. He's the managing director of the Tennessee office for Prime Capital Investment Advisors. Will, how you doing?
Gentlemen, it's so good to be here with you at Deep Fried with Johnny out there working the board for us, and just excited to be here. And thanks again for the invite. I feel honored. I did not know that I would be returning.
Well, you did so well the last time, we had to bring you back.
Yeah, we did. We were very excited to bring you back. And our regular listeners may remember that Will came in and we did a BOSS series several months ago, the Business Owner Strategies and Solutions Campaign, which was named, the acronym comes from Jay and his big creative brain, so credit there again.
Thank you.
Yeah, where we discussed the planning needs of successful business owners. And, Jay, I feel comfortable in saying that not only was the BOSS series successful and continues to be successful in generating opportunities to serve the needs of various business owners, but honestly, it also provided for Will and I to join forces under the Gulf Coast Financial Advisor branding to pursue fee-based opportunities down here along Gulf Coast.
And that's great. That's what the objective is to make some connections, and that bridge built between the two of you has been great.
Yes, sir. So, Jay, Will, before I lay out today's topic, podcast topic, I got to add a little disclaimer. So when it comes to politics, the Every Dollar Counts podcast is agnostic. So, yeah, we joke around a little bit, or I do anyway. At the end of the day, we're not a political show in any form or fashion. So with that said, today we are going to talk about a pretty significant event coming up. In fact, it's coming up very quickly, the election. So today's topic is going to be, what are the financial impact of Trump stays in office? What do we end up if Biden, with a Biden presidency?
Can you say that word again?
No, I cannot.
Say it one more time. Presidency.
What if Biden becomes president? What if the Republican lose some seats in the Senate, lose control? Maybe Congress and the office of the president get aligned with the Democrat Party. What does all this mean for you, and particularly for your money? So, listeners, join us today. We're going to talk about this topic and really so much more related to it. But first, we're going to have our friends from Sloth Racer kick us off. So, Will, Jay, before we get going, we got a quick housekeeping for compliance. Jay Stubbs and First Protective are not affiliated with Prime Capital Investment Advisors, Qualified Plan Advisors, or Gulf Coast Financial Advisors, and Will Steih and Josh Null are not affiliated with First Protective.
But we're all really good friends.
So, guys, we're going to discuss three key areas for folks with investments or business assets to think about with the upcoming election. Those are taxes, stimulus, and market uncertainty. So, Will, with your CPA background, with your CPA hat that you carry around in your pocket, what I'd like to do is start with something that greatly impacts local business owners and business owners across the United States, the current state of income tax law. Do you mind? Let's talk a little bit about that.
Sure. I think what people have experienced, the most recent change to tax legislation was in December of 2017, the Trump tax bill, known more as the Tax Cut and Jobs Act. That particular bill really took effect for all of tax year 18, 19, and here we are 9 months through 2020. We have lower tax brackets. We moved from the top bracket from 40% down to 37%. A lot of folks know that or don't realize it, but over 90% of the small businesses out there are what we call closely held or pass-through entities. There was a very special provision in there called the Qualified Business Income Deduction, which was a 20% reduction to taxable income that took it right off the top. There wasn't anything special the business owner needed to do. Those are things that are going to line up into the crosshairs of another administration that has a far different tax philosophy. And those are things that we've enjoyed up until this point. We've also enjoyed the continuation of step up in basis for inherited assets. Of course, those are things that are typically subject to capital gains tax. Some people may even recall there's a corporate income tax that had dropped from 28 to 21%. So those are things that I look back on the 18, 19, and for the first quarter of 20 anyways, this prosperous economy that we're enjoying, a lot of folks will go back and attribute to a tax policy which was very favorable to business.
And so what we're seeing is if a Biden-Harris administration comes in, just to clarify, you are the CPA. I have no tax counseling advice degree. You do. So if we do have a Biden-Harris, his proposal is raise the corporate tax rate from 21 to 28. He would raise the top rate individual tax rate from 37 to 39 back to 39.6. And then I've also read will new limits on deductions and impose a 12.4 Social Security payroll tax on wages above 400,000. That's pretty steep.
Absolutely. So, Jay, that particular thing relates to, and some would kind of call it the payroll tax piece of this, and that is, falling into the crosshairs as a business owner across the board is going to have an impact, but certainly those above $400,000 of taxable income, basically a lot of the takeaways. Hey, let's go back to the way things used to be pre-2018, before the Trump tax bill. Let's revert to that. And in the discussion, it's going to go even further than that. It's not just reverting to it, but hey, let's add to it. Let's increase the payroll taxes associated for those in that bracket. And the 12.4%, you start thinking about that, for every $100,000, that's another $12,000. That's not income tax related. That's in addition to. So now we're talking about the effective tax rate of a business owner going from 40 up above 50%. It would be roughly 52% on a federal level.
Well, I got a question for you, because I think as Jay just laid out, these are facts. These are things that are put out in the press. There's not like they're trying to hide the plan that is coming into place. But I think it's fair to say that a lot of business owners, not to make an overly broad statement here, but had been kind of moving along through this current tax system as if it was going to, stay in place for the current sunset. What do you think, if you had to put a peg on it, if there is a change in leadership, how quick are they going to get in there and maybe make some changes, or significant changes, or maybe even try to get that thing kicked to the curb quick?
No, terrific question, Josh, and a framing of it, and that is, even in the conversation I'm having with business owners as recently as this week, it's like, oh, these are things that won't change. The Trump tax bill is not set to expire, or sunset is the term used, until December of 2025. We've got another 5 years. Well, the fact of the matter is, we may not have another 5 years. The fact of the matter is, you have a shift in who is in office, and that could happen as quickly as when the legislative session begins again on a federal level in 2021. They will begin to take strides and take steps to undo what we're seeing, what we've already experienced for the last 3 years.
And the end goal, I think, in a Biden-Harris administration is to raise, I've read, $2 to $3 trillion over the next decade, so that they can fund and pay for a lot of the things that they want to implement in this country. That's a 6% increase over, if Congress did nothing, that's a 6% increase in federal revenue over that decade period. And that's flat out to pay for stuff that they want to do. Not to get into the politics of the things they want to do, because we're not going to hit that on this show, but to raise $2 to $3 trillion, you got to bump up taxes.
And the thing that we obviously can't ignore, because we've all experienced, it's been 6 months since it was actually a Thursday in March when the NBA decided to go ahead and end their season due to COVID concerns. And obviously what fell along the line after that, soon after, was the payroll protection program. So one of the things we'd not budgeted for, one of the things we not anticipated, was the need to have an influx of dollars from the Treasury to help us survive through the period that we experienced, April, May, June of this year. This is ahead of any desire by the next party to do some special things. So we're talking about, if you take their $3 trillion and then you add back what's already been spent relative to COVID, those are some serious numbers. And again, being apolitical, I heard one pundit say that, hey, we were willing to come down $1 trillion in our demands if they would have only come up $1 trillion. And within about 10 seconds, I heard this politician basically say they're just throwing around $2 trillion worth of your tax dollars. Let's make sure we're very clear. These aren't their dollars. These are our dollars. These are the business owner dollars. And I think we all could agree, regardless who's in office, generally people aren't the best fiduciaries, aren't the best stewards of money that's not their own. If they didn't earn it, they're probably not going to be nearly as careful as I know for a fact my business owner clients are very sensitive to how they spend money. I want to make sure they get the best return on investment. That's not always the case when we're talking about the government.
Well, Will, you said something in there with stimulus, which is going to transition us to our next topic. But before we do that, I want to make sure that we're clear. Obviously, we're not sitting here telling anyone who to vote for. Obviously, you're going to vote in your best interest, what you think is best for you and your country. But I will tell you that from a financial advisor standpoint, from a business advisor standpoint, the fact that we're talking about these topics, Jay and I, by training, are not tax professionals. Will has a CPA background. In our business profession as business advisors and financial advisors, we do work hand in hand with some pretty proficient high-level CPAs to help our business owners at least plan for these things. The main thing is just not get caught flat-footed. Is that fair?
Absolutely. It's solutions to the table to take advantage of the tax laws that are in place, to perhaps look for the tax codes to give us tax-free growth, to get maximized tax deductions, and that's where we come into play. It's hand in hand with those CPAs. One little point before we transition.
Yep.
That capital gains tax rate. The writing here is a Biden and Harris administration would have one of those preferential capital tax rate increases that says anybody with income of $1 million or more, that capital gains tax rate goes from 23.8%. Would be taxed at 39.6 with households for above $1 million. That, to me, another very big jump. So
it's an over 50% increase to what was previously understood. And again, this is what people think they know about what's going to happen next. And oftentimes, and most CPAs would agree, is their clients are asking these questions after the transaction's already been consummated. So there's nothing you can do about it after the fact. These are things we need to consider prior to a transaction. And along the lines of capital gains tax, I alluded to this idea of inherited assets. For the longest time, there was this concept of, hey, whatever dear old dad had paid for it or granddad, hey, it's going to come downstream to the next generation. We'll get a step up in basis. So the fair market value at the day of death will be the new basis I use going forward, and any appreciation later will be taxed. Don't worry about the previous appreciation of that asset. All of a sudden, a lot of discussion around the fact is, hey, we're not going to treat it that way. We're going to allow for a cause for there to be a tax at that particular moment. So,
Will, I like to explain that a little bit easier for folks that are listening, because they might have said, what did he just say? But I understood it. If Dad paid $50,000 for the tract of land, and then 30 years from now, or 30 years down the road, it's now worth $500,000, that would be a $450,000 gain if Dad sold it. But if Dad dies with it, transfers ownership to the next generation, think sons or daughters or whomever, that step up in basis means there is no tax on that specific asset. That's a big, big deal. And if we have taxes on inherited assets, tracts of land, property, you name it, that's going to, and business interest, you name it, it's going to be a big deal.
Yep, totally agree. All right, so Will had mentioned stimulus earlier in our discussion. So I want to jump into, guys, our next bullet point, trillions of dollars. You said something a minute ago, Will, about throwing trillions of dollars around. I mean, I'm old enough to remember when, I don't know if it was a senator or who it was, but said, if you're talking $1 billion here and $1 billion there, now you're talking real money, right?
Exactly.
How quickly that has changed. But trillions of dollars of stimulus has been recently pumped into the economy through EIDL loans, through PPP, some of the efforts of the SBA, so on and so forth. What do you all, I'm going to throw this out as a question to either one who wants to jump up first, but if we have a change in leadership, what does that look like as the chickens come home to roost, so to speak? What do you think we're looking at there?
So with that thought in mind, and Jade alluded to this earlier, there's some, we call them preferences, desires, hopes for even, that we have to deal with what's already been done, and that did not promote economic growth. It was done to bandage, to put a tourniquet on it, to keep our GDP from further falling off a cliff these last 6 months. This is something that's we kick the can down the road, and now we're going to have to figure out a way to pay for it. This doesn't even factor back in the existing structure we had and the existing obligations that we've already been committed to, whether it be Social Security, Medicare, all the different programs, which obviously have a very important need to fit a certain part of our demographic, in that particular case, certainly seniors. There are higher tax rates coming. At some point in time, we're going to have to look at that and address it. Now, whether it's January, February of 2021, or if it's after the Trump tax bill sunsets in 2025, at some point in time, if we won't have the economic growth growing large enough, fast enough, and that would be the end game, is hopefully that could happen, but tax rates down the line will increase.
Very good.
There is no such thing as a neutral piece of legislation. That's a quote that our professional association, NAFA, uses, and I'm very involved in that organization, Josh and Will, as you know. But to state that there is no such thing as a neutral piece of legislation, all legislation produces winners and losers. Somebody or some groups or some larger groups are going to be taking a hit as they look at what ways to recapture some of this money that we're spending. And who's to say that I don't think we're going to see the results of those Band-Aids happen over the course of the next 5 to 6 years. I think it's kind of the next generation, folks. I'm thinking of my kids, your kids. They're going to be paying tons of money in taxes to shore this thing up financially down the road. And that to me is just a little scary, but it also makes me think, as I'm listening to this podcast, I better be making plans not only for my financial situation, but that of my children and perhaps even my grandchildren.
Very good. All right, so fellas, the third point, as a counterpoint to what Jay just said with the long view, the third point is something a little bit more short term that I know the three of us get. I would say it's fair to say we get asked fairly commonly, and that is for investors, we get asked simply, what should I do? Should I go to cash? How do I handle this election? What happens if Biden wins? What happens if Trump wins? How does that impact the market? So what I'd like to do with this, Will, particularly with you and I sharing the RIA, Prime Capital Investment Advisors, and similar investment philosophies, along with the support of Jay through First Protective on some of the risk management, is kind of dive in this topic a little bit to give us the opportunity to describe the investment services we offer as part of our practice and how we kind of take the long view. Do you mind to pick up that ball from there on how we kind of are guiding our clients through? Neither one of us have tarot cards. I didn't bring my pair today. And none of us have crystal balls, but we still have, we've also are old enough, we've been through several leadership changes and we've guided clients through those. How do you think we look at with our long-term view on investing as it relates to this particular election?
My general rule of thumb and I was just on the phone, might have been yesterday morning with a retiree, and he was really focused on the short term. He's really focused on, hey, what if he or his combination wins? And my primary question is to come back and say, listen, I'm going to remind you of the questions I've asked you before. What is the intended use of this money? In this particular case, he was looking at an IRA. It's retirement money. He's enjoyed the benefits of not having his RMD apply the required minimum distribution due to some tax legislation that was passed during the COVID situation. It comes back to what is the intended use of this money and what do you plan to use it for? That's the guiding principle from my investment philosophy as to what are we going to do with the money? How are we going to invest the money? How much risk should we take relative to the money? And when he settled down on that comment, because we need to make it very personal. So everybody's situation is obviously circumstance and fact dependent. But in his case, he needed to be reminded of, hey, this is actually intended to be an inherited assets for his adult children. That really helped him be reminded, and he didn't get caught up in what the pundits were saying. He went back to, hey, my personal situation says I should be invested this way. I should be invested for some 40-year-olds mindset because I intend for them to inherit it. That's particularly, so I always want to help people understand is be in counsel with your investment advisor. If you don't have, if you're not certain of it, ask for a second opinion. Ask for, get in touch with us and we can weigh in on the subject. But the bottom line is, what are these dollars intended for?
Well, whether it's qualified money like you just talked about versus non-qualified money, taxed, it's already been taxed or it's not been taxed yet. There are certainly a lot of ways within our tax code, especially the one that's been in law since 1913, which is my favorite, which is the tax-free growth and tax-free distribution from a life insurance cash value type of policy. So when people are maxing out their qualified money and making plans and arrangements for their retirement dollars, they can also say, well, where else can I sock away money that's going to be the most tax efficient? If they make too much money for a Roth contribution, if they have already done their 529 qualified plan education funding, the next step in the tax code is to look at our good friend life insurance and understand that sometimes it's a risk management play, sometimes it's an accumulation play with some tax efficiencies. Again, a long-term philosophy that helps somebody's financial situation over what we always say is longer than a 10-year time frame. Not short-term money, 5 to 7 years, but hit that 10-year time frame or longer.
Well, and I want to make a point, and I'm going to go back to my original disclosure of I'm not making a political statement here, but I recently watched on Netflix the Chicago 7. I don't know if you all have seen that yet or not, but it's set in the late 60s, and I was not born in the late 60s. I was born in the mid-70s, but it was just a reminder of the turmoil that the country was in through that time period and really extended into, about the time I was born and all the way through. I mean, I was just old enough to remember the Carter, President Carter, and some of the things that affected my dad as a young business owner back then. And my point of bringing that up is we survived that. We survived that time period. It wasn't fun. There was a lot of people had their lives changed during that time period, but this is not the first time the country has been in upheaval, with a change in leadership. Credit to the United States that has it baked in to the Constitution where you can actually have technically a complete revolution, if you will, every 4 years, if that's the will of the people. So what is going to happen is going to happen. I think the main point of it is to apply some common sense, apply some long view, and if you feel the need, have some professional guidance, particularly around some folks that maybe have been through some of these transitions before as it relates to helping people guide their, the emotion of money, the turmoil, maybe even turn off the news for a little bit might help, right? So All right, guys, let's go ahead and I want to give you all the final word before I wrap up the show on our three topics. So,
well, final word on kind of the person or groups that may be listening to this particular podcast on what do I do? I had a conversation with a good friend regarding his qualified money. What do I do with my 401k investment allocations when this election comes around? And what if this happens? What if that happens? And I specifically asked him, how long before you need this money? Are you in the retirement red zone? He goes, what's that? I said, retirement red zone, give credit to Prudential years ago. They came up with that saying if you're within 5 years of drawing income from your retirement plans, you're in the red zone. And he was like, no, I'm actually 7, 10, maybe even longer. I'm planning on working at least another 7, 8 years, maybe longer. And I said, then quite frankly, you don't really need to, let's be mindful and review it, but you don't need to be worrying about making any immediate changes that are going to have an impact on your money today based on this short-term election that's 2 weeks out. So if you're listening and you are in retirement red zone, you need to be talking with somebody. If you're outside of that red zone, maybe that frantic feeling could subside if you turned off the news.
Well, I agree with Jay wholeheartedly with that sentiment. As I'd said earlier, what is the purpose and intended use of this money? And certainly timing is a factor of that, right? Like I'm envisioning a fishing boat, sunshine, and tight lines. It's like, okay, well, how long away from that? If it's 20 years, then certainly we've got some flexibility here. And revisit your financial plan, revisit the basics, the fundamentals of what you are doing, what your behavior indicates. Are you saving? All these things you're doing, and stay focused on the horizon and not the short term.
Very good. Well, guys, great job yet again. We got a couple more shows to record I'm very excited about. And listeners, I do believe this is a great representation of the experience and expertise that Gulf Coast Financial Advisors brings to the table, combined with the significant resources of Prime Capital Investment Advisors and Qualified Plan Advisors. So if you're a business owner, you're plan sponsored, you're a decision maker, or you're just somebody that's planning for retirement and you're located here along the Gulf Coast, if you'd like to have a conversation about these issues, you can always call us at 251-327-2124, or you can set an appointment on our website at gulfcoastfa.com. That's gulfcoastfa as in financialadvisor.com. And then also to all you independent and semi-independent advisors and agents out there, and hearing the value that a Jay Stubbs could bring to your practice, you can find him at jstubbs.com. That's JAYSTUBBS.com. So, guys, thank you again. Many thanks to our producer, Johnny Gwynn of Deep Fry Studios, my co-host, Jay Stubbs, and to Will Steih coming down from Nash Vegas and joining us yet again in studio. Just been really enjoying the visits we've had, Will, and all the people we've been meeting, the business owners that we've been helping in their journey. So thank you for coming.
Thank you for having me. Terrific folks down here on the Gulf Coast. And it seems to always be sunny.
It is always sunny, yes.
Unless there's a hurricane in the Gulf.
Unless there's a hurricane.
Yeah. And then lastly, just finally, a huge shout out to all you out there that have joined Jay and I on this journey. And to those of you all joining us now, check out our previous episodes. You're going to be pleasantly surprised. Do you like the show? Do me a favor. Please subscribe on the Apple Podcast app or wherever you find your favorite podcasts. And while you're there, you would be doing us a huge favor if you would rate and review the show. It helps other listeners like you find us. Lastly, you like the show music? Go check out slothracerband.com. That's slothracerband.com. And they're going to take us home now. This has been Every Dollar Counts with Josh and Jay. Advisory services offered through Prime Capital Investment Advisors, LLC, PCIA, a federally registered investment advisor. PCIA, doing business as Prime Capital Wealth Management, PCWM, and Qualified Plan Advisors, QPA. Gulf Coast Financial Advisors is independent of Prime Capital Advisors. Information presented is for educational purposes only, is not an offer or solicitation for the sale or purchase of any securities. All investments involve risk, and unless otherwise stated, be sure to consult a tax professional before implementing any tax or investment strategies.